Welcome to The Explainer, where we get right into the source material to break down the big, complex topics. All right, so today we're jumping right into this massive economic tug of war over the future of the British pound. You've got these forces on one side yanking it higher, and then on the other side, you've got these powerful pressures trying to drag it right down. The big question is, who's actually winning this thing? Okay, first up, let's look at the forces pulling sterling up. We're going to call them Team Bull. These are the big reasons, the economic arguments that are making investors think, yeah, the pound is the place to be right now. So a huge factor for Team Bull is this strategy you hear about all the time, called the carry trade. Now, what is that? Think of it like this. Big global investors, they borrow money where it's super cheap, let's say Germany, where interest rates are low, and then they take that cash and invest it where it earns a much higher return, like in UK government bonds. They get to pocket the difference. And to do all of this, they have to buy pounds, which creates this constant, steady demand for the currency. And this chart, this shows you exactly why that carry trade is so darn popular right now. Just look at the yield. That's the return you get on UK government debt. It's way higher than its peers. I mean, that gap you see between the UK, the US, and especially Germany, that's just pure profit for these carry traders. It makes the UK a total magnet for their cash. And to put a number on it, that gap is 196 basis points. Now, if you're not in finance, 100 basis points is just 1 percentage point. So we're talking about a nearly 2% advantage over Germany. In the world of global finance, trust me, that is a massive difference. It really does act like a powerful magnet for money. And, adding fuel to this fire is the Bank of England itself. Now, they did recently cut interest rates, but the message they sent was crystal clear. Hey, don't expect any more cuts anytime soon. This is what people are calling a hawkish cut, and it basically signals to all those investors that the UK's high rate advantage, yeah, it's going to stick around for a while, keeping that carry trade really attractive. And look, it's not just about the interest rates. The UK economy itself has been surprisingly strong. This number here, 53.0, that's the services PMI. It's basically a survey of business activity. Anything over 50 means things are growing. And 53, that's the strongest reading in a whole year. And that, of course, gives investors a lot of confidence. Okay, so that's Team Bull. Now let's head over to the other side of the rope and check out the powerful forces that are trying to drag the pound down. This is Team Bear, and they see some pretty big cracks under the surface. So, Team Bear's number one argument, it boils down to two really stubborn problems. Services inflation is high, and wage growth is high. See the connection? People are earning more, so they're spending more on services, which just keeps pushing prices up. It's that classic wage-price spiral, and it's a really tough cycle for the Bank of England to break. Now, this number points to a much deeper, more structural weakness. The UK has what's called a current account deficit. All that means is it buys way more stuff from the rest of the world than it sells to them. So to pay its bills, it has to constantly attract money from other countries. It basically means the UK is living on the kindness of strangers, financially speaking. And getting that money is getting harder. See, the best kind of foreign money is what's called foreign direct investment. That's the long-term cash used to, build factories, create jobs. But as you can see here, that has completely dried up, falling to its lowest point since the 2008 financial crisis. And that means the UK is relying more and more on that short-term, jumpy hot money. And this is where the danger lies. This dependence on hot money makes the UK really vulnerable. If global investors suddenly get spooked for any reason, they can pull their money out in a flash. And when that hot money flees, the pound can fall, and it can fall hard and fast. Okay, so we've met the two teams, Team Bull and Team Bear. Now, let's get into the nitty-gritty. These are the key economic numbers that all the analysts are watching. These are the battlegrounds that will decide who wins this tug of war. All right, think of this table as your cheat sheet for the whole tug of war. For Team Bear to get the upper hand, you'd want to see services inflation and wage growth start to cool down, maybe fall below that 4.5% level, because that would let the Bank of England cut rates faster. At the same time, if that interest rate advantage the UK has over the US, the Gilt US spread, starts to shrink, well, that carry trade becomes a lot less attractive. But on the flip side, as long as that services PMI number stays above 50, showing the economy is growing, Team Bull is still very much in the fight. So with all these competing forces pulling in opposite directions, the source material actually lays out three possible futures, three potential paths for the pound over the next few months. So what's the most likely outcome? Well, analysts are giving this a 60% probability. And it's kind of a stalemate. Not a dramatic win for either side. The pound is expected to basically stay in a tight range, maybe drift a little bit higher as both sides just pull to a standstill. So in this base case scenario, the tug of war is pretty much a draw. You have Team Bull's high interest rates acting as a strong floor, right? It prevents the pound from falling. But then you have Team Bear's arguments, things like a strong US dollar, and they put a ceiling on it, stopping it from rising too far. But there's a 25% chance, a 1 in 4 shot, that Team Bull gives a massive yank on the rope. How would that happen? Well, if UK inflation just refuses to cool down, that could force the Bank of England to get even more hawkish and actually backtrack on rate cuts. That would make the UK's rate advantage even bigger, and you'd see money just pour in, causing the pound to surge. And finally, there's a smaller, but still very real, 15% risk that Team Bear wins. This could be triggered by something like bad news from the UK jobs market, or what's more likely, some kind of global shock that just scares investors everywhere. In a risk-off event like that, they would just flee from countries they see as vulnerable, like the UK, and the pound would definitely take a tumble. Okay, so after all of that, what's the one big thing you should take away from this whole thing? At the end of the day, the entire story of the pound right now really just boils down to this one central conflict. It's a battle between its internal strength and its external weakness. Those high interest rates are an absolutely compelling reason to buy sterling. But that reliance on foreign money is a constant nagging vulnerability. And that really is the question, isn't it? As this tug of war goes on, will the pound's high yields be a strong enough anchor to hold it steady? Or will some global risk come along and finally snap the rope? For now, that rope is holding firm, but the winner will be decided by which of those key battleground numbers we just looked at moves first.